Hey traders, and good morning. I decided I was going to do a little video today. Well, I actually tried this video yesterday. It didn't seem to work, so I'm going to redo it today. Um, so I've opened up a trade here going into earnings on Verizon and AT&T. And you see Verizon on the left over here, and I have short 825 shares of Verizon, and I'm long 1,045 shares of AT&T. And I just want to talk about this trade for a few minutes, why I'm doing it. Now, um, one of the things that a lot of retail traders do is they really don't understand the institutional business models. And even my traders, when I teach them the floor traders, the market makers, and the prop traders business models, um, they still they understand why things are happening, but they still struggle because they don't accept one of the most important elements of trading, and that is that the real secret to institutional trading, okay, the difference that separates institutional traders from, uh, the average retail trader, is the secret is to find a great trade. They both do that. They both look for great trades. Once a institutional trader, I'm talking about somebody gets paid a salary. Okay, I'm not talking about these people out there that make videos and say they're professional traders. They're not. Okay, a professional trader is somebody that gets a salary and gets a bonus on top of that salary and is managing other people's money. Okay. So once you are a professional trader, when you find a great trade, you would never, or more likely than never, ever not have that trade hedged. So the secret to institutional trading, listen carefully, is to find a great trade, take the other side of the trade off with some type of protection, then annihilate that trade. Okay? And that's what we're doing here. I believe that Verizon, which is reporting earnings on the 24th, is going to miss. My analysis suggests possibly somewhere around 90 cents, and it could be 120. The estimates are coming in at 111. But I think even if it beats, I think just the fact that so many people are cutting the cable, and they're getting away from big box TV and moving more towards. Anyway, I have my reasons. Okay, I have my fundamental reasons. I'm sure you have your fundamental reasons as well too. So I have my fundamental reasons why I believe this is going to miss. But that being said, I would never just take the trade naked. So the beauty of this trade is twofold. First of all, I get to see how the market reacts to the actual earnings of Verizon. So what I'm expecting is I'm expecting a retest of about 43.99, right? No, not probably won't happen like the day of earnings unless they miss by a lot, which I don't think they're going to do. But I think that, probably 46 and then grind its way down. Okay, that's what I think is going to happen. So I have my idea. Now, um, I'm willing to put, let me just share with you something here. I'm willing to put approximately BZ, this is not the right number here. Verizon is currently trading at 48.75, and VZ or T, forgive me, is trading at 34.90. Okay. Now I'm willing to put $80,000 to work on this trade. Okay. And that's how I came up with the share allocation. Now, the key takeaway from this is that something else that a professional trader would never do is they'd never be completely committed to the trade. In other words, what I'm going to do is I'm going to leg into this trade, and I'm going to explain why. So this is my first tranche of 80,000. I'm willing to go another 80,000 and another 80,000. So I'm willing to invest 3 times in this trade if I have to on my larger idea. Now, here's the beauty of hedging. Let's assume that I am right and Verizon does drop down here and the trade is good. Well, what's going to actually happen to the correlation at that time? Well, let's say Verizon. First, let me just digress for a second. I want you to look at the spread between the two. Okay, so Verizon is in the white, yes, white, and AT&T's in the red. Okay, so if you take a look, this is approximately 1 year. Okay, the spread between these two is about 15% approximately. Okay, so you've got a spread of 15%. Now, if you go back and you look at a shorter time, actually go forward and you look at a shorter time frame, you see there's about a month. Now, over the last month, the spread between the two is about 7%. Okay, in other words, the difference between the two prices is about 7%, with Verizon being the stronger one at only down 0.29 on the month, where T is down almost 7% on the month. Okay, and so the very first thing that you need to do when you're doing these trades is you need very highly correlated assets, and you can see here that Verizon and T, at least since 2013, last 5 years, they move very highly correlated together. And so what this trade is actually in essence saying is that I believe that after earnings, this spread between these two is going to tighten up in one form or another. You understand? You can see that the spread here is like 7% difference, where the spread here was 3 and -3. It was almost there was almost no difference between the two. So that's really what the trade is all about. Okay, the trade is about the correlation coming back into alignment with each other, and using the earnings catalyst to see if I can get that to happen. You should take a look right here. This was the last earnings. Okay, so just quickly, at this time, the spread between the two, if we use this scale, was -7%. Okay, in other words, Verizon was T was down 7% on that time period, and Verizon was up 10%. And you can see after earnings what happened. T rose to being only down 2.87%, and after earnings, Verizon crushed and was only down 4%. So, do you see how that spread tightened between these two? Okay, let me show you that again. This is prior to earnings. T was at -8 and it gained 6%, well 5%. Verizon was at 11% and it ended up losing that whole 11% after earnings. Okay, so the spread between the two tightened, and that's sort of what I am looking to do right now. I'm looking to use the catalyst of this earnings to see if I can get this spread between these two to tighten. Does that make sense? Now, you can't just do this willy-nilly wild like this all the time and, pop up every earnings, because you can see sometimes it will work and sometimes it won't. In this particular case right here, we can see that it really kind of, it did okay. I think the trade would have broken even on this particular situation. In this case right here, look, they were very correlated and the earnings actually separated them. Okay, the earnings actually separated them during that correlation. Okay, so you got to know what you're doing. It's not just a simple matter, but I want you to conceptually understand that institutions never, or I shouldn't say never, but rarely ever take binary outcomes. Okay, there's always some derivative hedge, or there is a correlation hedge that we try to put on. Okay, and some people take it to extremes and they'll have 3 or 4 hedges on. Like I could add in another correlation here. I could add in something like I could add in let's see, VT, Verizon T. I could add in I'm trying to think of another biotech company. Anyway, it doesn't matter. So what I'm actually expecting to happen is here's what I expect the trade to do. Okay, so we're going to take this right here, and here's the outcome that I expect to happen. Okay, we'll do blue. Okay, so Verizon reports earnings first, right? Yes. Make sure of that. Yes, Verizon reports on the 24th. So here's what I expect to happen. Okay, let's say that I'm totally wrong and Verizon rallies really strong during the day. Well, what VZ will do, or what T will do, is T will rally too. But more than likely, the percentage that it rallies will be less. Okay? So my trade in this context is going to work against me, because in this case, the spread between the two will be bigger. It won't tighten. Okay, so that's the worst case scenario. So the worst case scenario is that it won't tighten, and the best case scenario will be that it does tighten. In other words, the best case scenario will be that here we are right here, and the earnings will miss or be bad, or the reaction to the earnings will be bad, and VZ will drop hard, and what will happen is T will follow, but the reaction to it should be like that. Okay, so there's the two possible outcomes. The third possible outcome is there will be no reaction at all, and that will be good too. Okay, so if this bad scenario happens, the reason why institutions hedge, pay attention people, okay, it's really important, is because it now gives me flexibility on this trade. Once I've seen what's happened with this trade, okay, I have a pretty good idea of what to expect with this trade. So if something bad happens when my trade does not work out the way that I want it to do, okay, I'm actually pretty happy at this point in time. Let's say it's a big beat, a big giant beat, right? And it's rallied. Well, guess what I'm going to do tomorrow, or sorry, when the day before VZ beats. I'm already in profit, and I'm going to probably add to that trade. Because I have a really good idea, not only did they beat, but I've also seen the reaction to that beat. So that gives me flexibility in this trade right here. Okay? Now what happens if they miss and the spread tightens? Okay? What happens in this situation? Well, again, I'm very happy. I'm very happy because I have more information. Okay? So what I can do is I can take the entire correlation off and just, or I can take it all off and just take that profit that I would have there, or I can add to my shorts. Okay? You understand what I'm saying? Okay? Sorry, in this case I would actually take this off and let this run. Forgive me, that was a mistake over here. Okay? In this case, I would just take off the short position. Okay? Wait. Let me get that right. Right. No. In this position, I would take off the short position, forgive me, and I would just let that run because I'm short VZ. Okay? So I'd take off this position, I'd let this run and add, forgive me. Okay? Now in this position where the trade works out and I'm short, I'm long the T side, forgive me, I did that wrong, I wouldn't add. Okay? I just take that position off, okay, and I would add to my shorts. Okay? Remember, I've got two targets in this situation. I'm looking for two events to happen. I'm looking for 46.15 to be hit, and then I'm looking for 44.30 to be hit. So you have to think the trade through completely. So when I see the bad news, I see the market reaction to it, I take off the side. Okay? Or the other choice is I just leave the entire hedge open, waiting for the correlation to tighten. That makes sense? Okay? So, the main takeaway that I want you to take from this, guys, is to, first of all, never be overly exposed, especially on earnings. Always, I do play earnings trades with a binary outcome, but if I do it, I always do it with an options trade. Okay? I will always do it where I know exactly what my risk is. So, for example, I am short. I'll share with you guys a couple other trades I got working right now. I am short a couple of earnings trades, and that is I am short some options on ATGE. I am short some options on LRN, and I am short some options on LOPE. Now, I know exactly what my risk is on this, so I'm all in, all out, okay? They're coming out with earnings on the 22nd. They're coming out with earnings on the 24th, and they're coming out with earnings on the 3rd, okay? So these particular trades, I'm all in, right? That's it. I've got like, $500 risk. I can't lose anything more than that. And potentially, I think this level down here is going to get tested at 40. If I'm right, I'm going to have a huge, 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 huge win. Okay? Same here. I got $500 all in. I'm not exactly sure. I think 101, 102 level is what I'm looking for here on LOPE. And ATGE, same thing. I'm looking for about 46. So I'm all in, all out. Okay? When you're managing money, you always want to be controlling risk. Okay, Paul Tudor Jones said it very, very well, and that's really the takeaway from all of this. The takeaway is that if retail traders spent as much time on their pie in the sky ideas of how to get into trades, if they spent as much time on that on controlling risk as they did on that, they would all be wildly successful. Okay? When you manage money like I am doing right now, you never want to be overexposed on risk in a binary outcome, right? For example, just to give you an idea here, I do like to trade biotechs occasionally, and there's a couple of trades I'm looking at right here. RARE just came out with approval on this drug right here. Now, I think the market's going to drop to about 42 over the next little while, but I'm never going to just short that because anything could happen, right? Let's just say that even though I'm bearish on this asset and I think it's going to drop to around $43, okay, this company could be taken over, right? So let's just say that I just take a short here, right? And because I think a market's going to go down, usually after these drug approvals, especially this particular one, there's not a big demand for it. And my students will understand by looking at the chart why I think this is going to drop. Okay, so with something like this, I think it's going to go down. But this company could be taken over, right? I mean, what would happen if Pfizer decided to take over this company and I'm short at 53 and the stock's at 90? I'm dead forever. I just blew my account. Gone. Bye-bye. Right? Right? Your account's just toasted. Right? And worse, you can be in debt to your brokerage firm. Right? So even when you have a strong bias, which I believe that this stock RARE is going to drop, just taking it in a naked fashion is really what retail traders do all the time, right? You overexpose yourself to risk. So what do you do in this situation? You go and you find some options, hopefully, right? And you structure a trade, Gabor, if you're listening, you structure a trade where you've limited your risk and you can maximize your gain. I'm going to repeat it the second time today. Listen carefully. The secret to institutional trading is to find a great trade, take the other side of the trade off with protection, and then annihilate it. That is the secret to institutional trading. Okay? All right. So if you'd like what I've been talking about so far and you want to learn more about it, I don't particularly teach hedges in my current course that I offer on my website. However, I am going to be offering that going forward, primarily because when I was a day trader, I never hedged. All right? When you day trade, there's no need to hedge because really you can control risks during the day with stops. However, when you're swing trading, you want to make sure that you're hedged because there's so much overnight risk. And let me tell you, I lived through 1987 and it was, Monday morning, everything was great. And, by Monday afternoon, by Tuesday and Wednesday, the whole world changed. Okay? Overnight risk is something that you never want to expose yourself to, especially with this, bizarre, wacko, crazy president in office that's doing all kinds of nutso things. And God knows what can happen. You could wake up in the morning and he's tweeted that, I don't know. Anyways, I don't want to get off. This video has gone 25 minutes longer than I really wanted it to do, but I really wanted to make a difference between, I really want to make a video on the difference between how a professional trader manages risk versus how a retail trader manages risk. Never leave yourself overexposed without knowing and controlling your loss. Again, if I go back to my Verizon trade, can this trade work out, cannot work against me? Hell yeah, it definitely can work against me. But I have options because of two reasons. Number one, I get to see this earnings date before this earnings date. Number two, I am only taking 1/3 of the trade as an opening trade. Number three, I know historically that this asset is very highly correlated over a very large sample size. And I also know that the average spread between these two does not like to go too much further than about 15%. Okay? Historically, it likes to stay within 15% of each other approximately. It doesn't get too far away from each other over a longer term perspective. So I have some data that I can work with. Okay? Can the trade go against me? Can I lose money? Absolutely. But I want to put myself in a position where even when I am wrong on my analysis, I have a way of controlling my risk. Okay? And that's why we do it. And I think that is the biggest takeaway that retail traders need to understand. You know, everybody talks about risk management and using stops. Well, using stops is usually never very, very effective unless you're day trading, because when you use a stop when you're day trading, you have a very specific outcome, and you can see whether that outcome is going to actually work. But when you're trying to use a stop when you're swing trading, it is less effective because, like I said, what would happen if all of a sudden Verizon gaps to 52 overnight, right? Let's say my stop is 49, right? I'm short this, right? What happens if overnight it gaps to 52, right? Well, let's say my stop was here at 49. Now I'm sitting in a big loss. Okay? And that happens, believe me guys, if you trade long enough, something like that will happen to you. Right? It's just a matter of time before. That's why when I see all these people out there, they're selling you courses and they're telling you, I made this much money doing all this over the last 3 or 4 years. I chuckle. I chuckle. And you should be very worried about that because, they just haven't seen enough sample size in the market, right? Let's say you always take a trade and for the last 5 years this trade ends up working, whatever this setup is, right? Well, guess what? Markets change. Volatility increases, volatility decreases, volatility spikes, volatility goes down. It's not unlikely that you're going to be in a trade like this, and let's say the average move was always $1, then all of a sudden the average move is going to go to $5 against you. And boom, you wiped out your account. There's no replacing experience when it comes to trading. Don't look at these bozos that are out there selling you courses, these young kids that have been doing well for 2, 3, 4, 5 years, right? They're all out there, okay? And, they tell you, I've made $1 million. Do I believe them? Probably 1 or 2 of them I think is honest, right? But even those people, they just haven't seen enough trades. They haven't. They don't have the experience. And all it takes, you can work for, 3 years to build your account up to $1 million, and then boom, a trade that usually looks like it's going to work will end up opening up here. and your entire account's blown because you don't understand how to control risk, right? And that is the crux of it. You worked for 5 years, now you're broke. You know, Jesse Livermore in Reminiscence of a Stock Operator was a very good example of that. Okay? So, professional traders, especially when you're managing money, always have a way to control risk. The secret to institutional trading is to find a great trade, take the other side of the trade off with protection, and then annihilate it. Hope you guys enjoyed this video. Okay? And bye for now.